Welcome to the deep dive. Today, we're doing something really specific, a sharp focus on the numbers behind a major corporate shift.
That's right.
We're looking only at the recent Q4 2025 earnings call, and specifically just the financial deep dive from the CFO's opening remarks.
Yep, cutting straight to the financial core here. No CEO talk, no Q&A distraction for this one.
Exactly, because this isn't just about one quarter's performance, is it? This material, well, it gives us the financial proof points, the evidence that this big multi-year turnaround plan, it's actually starting to gain some real traction.
It really is.
So if you're looking for that financial roadmap, maybe trying to see where things are headed next, this is definitely the deep dive for you.
And, we're honing in on the financial side because Q4 2025 was, well, it was a pretty significant moment. It marked the first positive quarter of global comparable sales growth in 7 quarters.
7 quarters. That's quite a streak to break.
It is. A long run of decline or just, flatness.
Yeah.
Finally broken. So we're going to unpack the numbers, the data that shows how they managed that turn.
And what it costs them, right? Because there's always a cost.
Oh, definitely. We'll get into the margin story, too. It's crucial context for that turnaround.
Okay, let's jump right in then. The top line numbers the CFO laid out. Consolidated revenue for Q4
hit $9.66 billion.
which is up 5% compared to last year. It looks like a solid number on the surface anyway.
It is solid, yeah. But the real story, as always, is inside that 5%. The CFO broke it down quite clearly.
Okay.
So 2% of that growth, that came from net new company-operated stores opening up. The physical footprint expanding.
Standard growth driver.
Right. But the other piece, the bit that really caught everyone's attention, was the 1% increase in global comparable store sales.
Ah, the comps. That 1%. That's the gold nugget, isn't it?
Absolutely.
Just to remind everyone listening, comparable store sales or comps that measures growth only in stores open for at least a year. So it cuts out the noise from new openings.
Exactly. It's the pure measure of the health of the existing core business.
And for 7 straight quarters, that number was 0 or negative.
Flat or red, yeah. So hitting positive 1%, even just 1%, it signals that the core stores aren't just, stopping the bleeding anymore. They're actually starting to heal.
It's the proof point management needed, you think, to show investors these big investments are finally changing customer behavior.
I think so. It shows the foundational stuff is starting to pay off, yeah.
Okay, so now let's zoom into the U.S. This is where, a lot of that investment in labor and service has really been focused. Overall, U.S. comps were flat year over year.
Flat, yes. But again, you have to look under the hood. What drove that flat number?
Right. So the average spend per order, that was up 1%.
And the CFO was really direct about why. She linked it to pulling back on discounts, fewer promotional offers.
Okay, so less reliance on cheap deals to get people in.
Precisely.
Right.
Which ideally increases the profit on each order, but also, helps the brand's value image long term.
Makes sense. But the other side of that coin, U.S. transaction comps, so the actual number of orders, they were down 1%. Now, that still sounds like a bit of a problem, doesn't it? Fewer people ordering.
Well, yes and no. I mean, down is down. But it's a problem that's shrinking, and shrinking fast, that negative 1%. It was actually the 4th quarter in a row that number got better.
4th consecutive quarter of improvement. So, okay, so they're slowing the decline, hitting the brakes.
Exactly. Braking hard on that downward slope, they're almost back to 0, almost flat on transactions.
So even though it was technically still a decline, the trend is the key thing here. 4 periods straight of slowing the loss. That sounds like the first real signal the investment is hitting home.
I think that's fair.
What did the CFO specifically credit for getting transactions almost back to positive?
She really highlighted September. That month, she said transaction-led comp growth was actually getting close to positive 1%, a big swing.
And why September specifically?
2 things, mainly. It was the first full month. They had the Green Apron service rolled out everywhere, all U.S. company stores. And the timing of the fall menu launch was apparently quite favorable, too.
So the better staffing, the service improvements, it actually translated pretty immediately into more visits.
That's the implication, yes. It suggests that investment in labor and quality does drive traffic.
Okay, let's shift gears a bit. How are they connecting with customers? The digital side, the rewards program.
Right, Starbucks Rewards. The 90-day active member base, it grew, but kind of slowly. 1% growth quarter over quarter, and also 1% year over year.
Bringing it to, 34.2 million members?
That's the number, 34.2 million. Slow, steady growth in your most loyal group. It's generally good.
But I sense a but coming.
Well, the really interesting thing the CFO pointed out was this. The non-Starbucks rewards customers, their transactions also grew year over year. And that was for the second quarter in a row.
Hold on. So the super loyal rewards members are growing slowly, and the casual walk-in non-member customers are also coming in more often. Both groups growing at the same time.
Precisely. And that dual growth, that's a really important signal.
Why is that?
Because it suggests the changes they're making, the better staffing, the cleaner stores maybe, the faster service from those green apron investments, it's working for everyone, not just the people chasing points.
Ah, okay. It validates the core value proposition is getting better, not just the loyalty mechanics.
Exactly. It's broader appeal.
Okay, let's look overseas. International performance. The segment reported, what, 9% year-over-year net revenue growth?
Yeah, strong growth. Hit a record, actually. Over $2 billion in revenue for the quarter from international.
Wow. Any specific markets driving that?
She called out a few key ones. China, Japan, the UK, and Mexico were highlighted as having particularly strong comp performance. They were the engine room, basically.
China's always the big one to watch. Comps there grew 2%. But wait, you drill down. The transactions grew much faster.
That's right. The overall comp was 2%, but that was driven by a really significant 9% jump in comparable transactions. Lots more foot traffic or maybe delivery orders.
What's pulling people in there?
Two main things mentioned. Product innovation, specifically some successful tea lattes apparently did really well regionally, and just the continued growth of their delivery business over there. It's huge in China.
Adapting to the local market.
Definitely. And speaking of China, the CFO also touched on that big strategic question, finding a partner there.
Right. The ongoing search for a strategic partner to help unlock more growth. Are they any closer? Or what's the stance?
Sounds like they're still looking, but they're holding really firm on what they want from any deal. They're not just going to give it away.
Okay, what are the requirements?
She laid out three kind of non-negotiables for the value they expect. First, a significant upfront cash investment from whoever partners with them.
Right. Get paid now.
Second, Starbucks has to keep a meaningful equity stake. They want skin in the game going forward.
Okay, share in the future upside.
And third, they need to lock in future royalty payments, an ongoing income stream.
So, cash up front, a piece of the future growth, and ongoing royalties. That sounds like... Well, it sounds like they think that China business is going to be worth a lot more down the road.
It signals a ton of confidence, doesn't it?
Yeah.
They're basically saying this asset is valuable, we know it, and we're not selling it cheap or giving up control easily. Yeah. It's a strong negotiating position.
Okay. Smart. Now, outside the cafes, what about channel development? The stuff you buy in grocery stores.
Also doing really well. That segment, net revenues grew 16% year over year.
Yeah.
Big boost from the Global Coffee Alliance.
That partnership seems to just keep delivering.
It does. And they're still leading the market share in North America for ready-to-drink coffees and the at-home coffee categories. Solid performance.
Any innovation highlights there?
Yeah, a quick anecdote. They launched a protein drink in the UK. It was apparently so successful they expanded it to 8 more markets just in 2025. So the CPG innovation engine is definitely humming.
Okay, so we've got top-line growth, positive comps finally, traction in the U.S. seemingly improving, international strength. But now we hit the cost side of the equation.
Right.
The trade-off. The Q4 consolidated operating margin, it contracted a lot, down 500 basis points from the prior year, settled at 9.4%. That's a pretty hefty hit to profitability.
It's significant, yeah. 500 basis points or 5 percentage points. That's the direct financial reflection of making these huge turnaround investments.
What did the CFO point to as the main drivers of that contraction?
2 core things, really. One was persistent inflation, specifically called out higher coffee prices and tariffs. Just costs going up.
The usual suspects.
Yeah. And the second, bigger driver was the strategic investments themselves. The Back to Starbucks plan, mostly meaning the significant increase in labor hours for that green apron service model. Paying people more, having more people working.
So this brings up a key question. Is that huge margin hit a sign they maybe misjudged the cost? Or is it genuinely just the planned price of the turnaround?
The way the CFO framed it, it sounds very much like a calculated risk, a deliberate trade-off. Okay. They're essentially saying, we are choosing to take this margin pain now in the short term because we're pouring money into fixing the foundations. Better staff, better operations, better training.
With the expectation that this leads to, what, healthier growth later.
Exactly.
Yeah.
The idea is this investment repairs the core experience, which leads to more sustainable, higher quality sales, and ultimately more profitable transactions down the line. Short-term pain for long-term gain.
Okay, but investors will want to see they're managing costs somewhere else, right, to offset some of the spending. Did she mention any controls?
She did. General and administrative costs, G&A, consolidated G&A actually decreased 2% compared to last year. Came down to about 6.6% of total revenues.
So belt tightening at corporate while they invest heavily in the stores?
That's the picture, yeah. Showing discipline where they can.
Mm-hmm.
And they also made some tough calls on the store footprint itself.
The closures. Tell us about those.
Yeah, she mentioned 107 net store closures globally in Q4. These were locations that basically couldn't meet the new standards, either for customer experience or profitability, or maybe both, even with the extra labor investment.
So, cutting the underperformers. Units dragging down the average.
Pretty much. And this leads to a really important financial term she used, accretive.
Accretive, right. The CFO expects closing these stores, while it reduces overall revenue a bit in North America. It should actually be slightly accretive to operating margins going forward.
And that word accretive is key for listeners to understand. When closing a store is accretive, it means you lose the sales from that store, obviously, but you lose the losses and the overhead costs associated with it even faster. So the overall profit margin of the remaining healthier stores actually improves.
Got it. So it's like pruning a tree, cutting off the dead branches, makes the whole thing healthier and more productive.
That's a great analogy. They're pruning the network to raise the average quality and profitability.
Okay, but even with these offsets, the sheer cost of the investment meant Q4 earnings per share, EPS, came in at 52 cents. That's down 34% from last year.
Yeah, a big drop.
So this whole section really screams turnaround in progress. It's messy, it's expensive, but we believe it's strategically vital.
That sums it up pretty well.
All right, let's look forward then. Fiscal 2026. Did the CFO give any guideposts, any sense of the path ahead?
She gave a few key indicators. On the cost control side, she explicitly stated that consolidated G&A for fiscal 26 is expected to run lower than it did back in fiscal 2023.
Lower than 23 levels. Okay, so that commitment to keep corporate costs down continues. That's a big piece of the offset puzzle.
It is, that lower G&A plus the accretive impact from closing those 107 stores. That's the financial cushion they're building to help absorb the ongoing store investments next year, trying to stabilize that margin.
And what about the U.S. performance, the comp sales trend?
She sounded, I'd say, cautiously optimistic. Said U.S. company-operated comps should build through the year, so improve as fiscal 26 progresses.
But there's always a but with guidance.
But she added a wise caution. Recoveries like this are not always linear.
Meaning, don't expect a smooth, straight line upwards every single quarter. There might be bumps.
Exactly. Managing expectations. It's a huge operational change across thousands of stores. It won't be perfectly smooth. And we also have to remember the cost side is still evolving.
How so?
The concept of annualizing costs, those big investments they made in Green Apron service this past year, they'll continue to annualize through fiscal 2026.
Okay, let's clarify annualizing costs for everyone. What does that mean in practice?
It just means, they started paying those higher labor costs partway through fiscal 2025. But in fiscal 2026, they'll be paying those higher rates for the entire 12 months.
So the full year impact hits the books in 26. It's a known cost headwind they have to overcome.
It's a known headwind, yeah. A burden they have to essentially grow into. The improvements in sales and transactions need to ramp up faster than those costs fully annualize if they want to rebuild the margin quickly.
And the overall goal, the big picture aim articulated by the CFO, still the same.
Still the same core focus of this whole multi-year turnaround. Make sure every single transaction is higher quality and more profitable. That's the mantra.
Okay. Now, despite all this margin pressure, the cost headwinds, the non-linear recovery warning, the CFO also pointed to something else, a sign of confidence.
Yes. And arguably the most powerful signal they could send right now. Despite everything we just talked about, the margin hit, the turnaround costs, they announced an increase to the quarterly dividend earlier in the month.
Raising the dividend payout to shareholders now, in the middle of all this, why is that such a big statement?
Think about it. Raising the dividend and making a point that it's the 15th year in a row they've done it, it's management looking shareholders in the eye and saying, essentially,
what? Trust us.
Pretty much. We know this margin pressure looks bad right now, but we believe it's temporary and it's under control. We are so confident in the sustainable profit we're building with these investments that we're willing to commit more cash back to you right now.
It signals belief in the long-term plan's success.
Immense belief. It's an expensive way to signal internal confidence in future durable growth. Actions speak louder than words, right?
Oh.
Hashtag tag outro.
Okay, so let's wrap this up. What's the core takeaway for you, the listener, trying to understand this financial story just from the CFO's perspective?
I think the main message from her remarks is pretty clear. The company is making a very conscious choice. Prioritize fixing the foundations, the customer experience, the store operations via labor investment, cleaning up the portfolio over maximizing profit today.
Mm-hmm.
They're accepting that big 500 basis point margin hit now because they believe it's necessary to drive sustainable, truly profitable growth later on. They seem done with trying to cut corners if it hurts the core offering.
Quality over immediate profit.
That's the trade-off they're making.
And given that warning from the CFO that the recovery won't necessarily be smooth, not always linear, it leaves us with a key question, doesn't it, looking ahead?
Yeah.
The crucial financial balance seems to be this. How quickly can those costs offset the lower G&A structure, the positive impact from closing those accretive stores? How quickly can those benefits start to outweigh the drag from the full-year annualization of the green apron service costs?
That's the tug-of-war right there.
Stabilizing and then rebuilding that operating margin back towards historical levels, that really feels like the financial battleground that will define their fiscal 2026 story.
Agreed. Watching how that margin evolves quarter by quarter will be fascinating.
Well, thanks for digging into just the CFO's numbers with us today. A very focused deep dive.
My pleasure. It's always insightful to focus just on the financial narrative sometimes. Thank you.